Welcome to In the Money. I'm your host, Daniel Dent. Over the last 20 years, I've worked with families and businesses, helping them become financially savvy. And now I'm going to do the same for you. Each show, I share personal financial topics to help you make better informed financial decisions. Football scores, basketball scores, baseball scores. I bet you can tell the score from the Grizzlies, University of Memphis, or Redbirds' last game. But the most important score is your credit score. And if you're like most people, you probably can't quote that one. Credit scores are based on the activity in your credit report and determine whether you will have a higher or lower interest rate when you borrow money. The difference between a great credit score and a poor credit score determines how much interest you pay. For example, if you take a $30,000 5-year car loan and your rate is 2% instead of 7%, you'll save over $4,000. If you take a $200,000 home loan and your rate is 4% instead of 7%, you'll save about $136,000. Joining us today to help us navigate credit reports is Regina Palmertree with Memphis Consumer Credit Association. We're telling you what to do to get your score up and save you a bunch of money. Stay tuned.
You are watching Germantown Municipal Television, your source for everything Germantown.
We're discussing credit reports and credit scores today. Joining us is Regina Palmertree with Memphis Consumer Credit Association. Regina, welcome to the show. Thanks for coming out.
Thank you.
Before we get started, tell us a little bit about yourself and what you do.
Okay. I work with Memphis Consumer Credit Association, which is a 65-year-old company located here in Memphis. And prior to that, I was 27 years in the mortgage business. So I understand credit and the process and everything surrounding it.
So it's safe to say you've looked at a few of these credit
Just
reports, right? Okay, great. Then you're the right person to have today. So credit scores, very important. They lead us to either paying more in interest or being able to save more money. But let's talk about how have you seen this in action? What are some of the good things you've seen from having a good credit score and some of the bad things that you've seen with having a poor credit score?
Just like you said, it can help you in obtaining a better interest rate. It goes everything from a mortgage loan to car insurance to even a job. So everything is important about credit. So it's important to establish it and maintain it.
Yeah, we had a nonprofit on a few shows ago, Operation Hope, where one of the things they do is work in underserved markets and try to help people get from those lower scores in the 600s to a 700 plus score, just because of the impact, not that it has on them individually, or not just that, but to the community as well. It helps put more money in the economy and puts people in a better situation. But let's talk about the score itself. What does the score consist of?
Okay. The primary part of your credit score is how you've paid your debt. So of the score, about 35% of that number is basically how you've paid. And everything else goes to how long you've had an account, how much credit you have, and how long you've had it. So it's a huge combination. It's a scientific method, with the largest part being how you've paid on time.
Okay. So what's the range of a good score, or just let's talk about the range in general, and what constitutes a good score, and is there a line in the sand where you go, gosh, we really need to try to get our score higher?
Generally, it's about an 850 is the high score, and then it can go anywhere down into 400. And obviously, the higher the score, the better the credit. Based on that, it can, like we said, dictate anything you purchase and anything you do in life is based on that score.
So do we know what the average score is in the U.S. or the Southeast, I guess?
We're looking at about a 670 average credit score. And for most mortgages, they need about a 640 to a 620 is the lowest. There are some that go a little bit lower, but again, the higher the score, the better the rate.
So if I'm looking at my score and I'm very goal oriented, so what should I be shooting for? Just as high as I can get, or is there some point that says, all right, 770 is a great score and above, or is there any kind of delineation there?
No, everybody wants the perfect score, and there really is no perfect score because that score is also a snapshot in time. So it is based on today. And you could have a payment that you just went and charged up a credit card at Penny's and bought some Christmas. And when that gets reported, that could alter that credit score a little bit because your balance is higher. So it's not so important to focus on your score as it is to focus on your credit, the actual accounts and how they're paid.
So we really control a lot of how our credit score is affected. It's not just a magic number that's assigned to us by a credit agency.
Correct. Right. And like I said, it's just based on everything that's reported and when it's reported. Companies report different times. They typically report by the 15th of every month, but they could report differently. And it's based on that credit card, when you charge it up, when you paid it off, what type of an account it is. And again, if you just got new credit. So when you go out and you go to Penny's and they say, open up a credit card for 10% off, you've had an inquiry and you've had a credit opened.
So what are some of the ways people unintentionally hurt their credit score?
Besides not paying on time, that's the biggest thing, is opening again too much credit. We don't advise going and getting the 10% off every time somebody offers you something, just because you again have established new credit. The other thing is getting the balances so high. Typically you want your your balance and your high credit about 35% of your high credit. That's going to improve your credit score. So the more you owe on a credit card, the more it hurts you because you're considered a risk.
So when you said 35% a balance of my high credit, what does that mean in English for our viewers out there? If you have a $1,000 line,
$350.
So you want to carry about 35%. And of course you don't want to have, as you mentioned, just too much credit out there either, because that could hurt you.
Right. And then again, you don't want to have any credit because then you're deemed as a credit risk, because the only way to know how you're going to pay me or pay anybody is to look back and see how you paid everyone else. So if you don't have any credit, we can't judge how you're going to do forward.
Let me ask you this. Tennessee's bankruptcy rate is 5.17 filings per 1,000 people. And that's more than double the national rate right now, which is about 2.39 filings per 1,000 people. What's the impact to your credit report when you declare bankruptcy?
It's a huge impact, and unfortunately we are the bankruptcy capital of the country. It is a huge impact on that. But everybody has to have the decision based on what they need to do, and everybody has a bump in the road. So if you have to file bankruptcy, it's best to get counseling on that and determine how's the best way to file it. But it will deter your credit score and affect it very negatively.
I always encourage people, go speak to a professional before you declare bankruptcy. I think, especially in our area, as you mentioned, we're the bankruptcy capital, unfortunately, I don't think people have a full or complete understanding of what that actually means to your financial future. And maybe they just see it as an easy way out. So it's important for people to go out and really get educated before they pull the plug on that deal.
Exactly.
Hang on to that thought. We're going to take a quick break, and we'll be back in a moment. More with Regina Palmertree when we return. Please stay with us.
Cinderella found the pet that fits her perfectly. Tiana gave her pet the royal treatment. Belle found beauty where no one else did. And you can too. Share your heart. Share your love. Bring home your forever friend. Make a shelter pet part of your world. Happily Ever After begins at theshelterpetproject.org.
Right, mi cariño. So like I said, everything I learned about cooking, I learned from Grandma's empanadas. Shall we go again?
Yep.
Mix beef with the onions with the peppers with the paprika with the garlic with the oregano with the cumin. Got it?
Got it.
Throw on the olives, stir, season, stir again, pour out the flour, roll out the dough, make a circle, drop in a fistful of filling, fold over, press down, and ta-da!
Most parenting is hard to do in just 2 minutes. But 2 minutes twice a day making sure they brush is easier, and it could help save them from a lifetime of tooth pain.
You are watching Germantown Municipal Television, your source for everything Germantown.
Welcome back to In the Money. I'm your host, Daniel Dent. If you're just joining us, we're talking about credit scores and credit reports and how it can help or hurt you with Regina Palmertree of the Memphis Consumer Credit Association. Regina, before the break, we talked a little bit about bankruptcy and the impact to your credit report. So I know a lot of viewers are out there asking themselves, well, what about if I have a debt settlement arrangement where a creditor will call and say, you don't have to pay the full amount, maybe you pay half of the amount or 70% of the amount. What's the impact of that on your credit? Because they make it sound very enticing, right?
Mm-hmm. They do, that's correct. And they will offer you that settlement, and especially on a mortgage, they will offer you that. And the issue with that is the difference that you settle with and what you owed is considered taxable income. So you will receive a 1099 at the end of the year from that company, and you will be paying taxes on that difference. So it sounds like a good thing, and sometimes you have to do what you have to do, but you need to know the issues that come afterwards.
And I'm assuming, just like bankruptcy, that would impact your credit somehow.
It does. It puts on a trade line within that account and says settled for less than the balance. So it will stay with you on that particular account.
Yeah, I think the key to remember is any creditor out there is just trying to get their money back. They really don't care about your credit score or credit report.
Exactly.
So let's talk about how you improve your score. And we touched on that a little bit in the first segment before the break. If your credit score is good, what's the best way to keep your credit score up there, up high?
What I would advise you to do, first thing is go to annualcreditreport.com and pull your report every year. Not only for the issue of monitoring your credit, it's also to monitor fraud. We are in that time, again, of the year where fraud is a big thing. But monitor that credit, because on a credit score, it is a different scoring model for when you're going to buy a car, when you're going to take out a credit card, and when you're going to do a mortgage loan. So the score can be different, each industry you do. So the best thing to do is just monitor that report, make sure it's correct, make sure nothing's reported incorrectly, or nothing's over on your report that's not yours.
Mm-hmm. You mentioned the score can be different if you're buying a car or a house or credit card. What does that look like? What are they looking for different things in your credit report?
It's looked at differently on certain things. Like on a mortgage, the model is different based on how much credit you have and how much you owe, just like on the credit card if you have more than 35% of the balance. Cars look differently. They're more on the late payment. So every model is different. So it really, to look at a score, you'd have to know what you're looking for as far as what you're typically going out there to buy.
So it sounds like the best thing to do, we can't control that as consumers.
Right.
It's just take care of our credit report by paying on time and doing those other things.
Right,
that we
and the score will
discussed.
automatically take care of itself.
You had mentioned going to a retailer and them offering 10% off on a credit card. What about closing a credit card? Because we hear mixed messages with that. If we've had a balance and we pay it off and go, all right, I'm done with this, is that always a good thing to do?
No, it's not, because again, if you close everything out, then we have nothing to look at, to report, to determine how you paid. So we advise you to keep some accounts open and nothing else, put a tank of gas on that credit card every month and keep it active. Everybody needs gas in their car, so go and do that and pay it off. Mm-hmm. But don't close it out, because then it comes out of the scoring model.
And I think the longer the line of credit, or the longer the time that you've had it open, is it true that will help it as well?
It will, because when you take out all these accounts at the beginning, then that's the natural shock to your credit, is you've had an inquiry, now you have a new account. And then over time, as you pay it, it becomes more forgiving on the credit score.
So as you said, it's best to have a longer history there and then not close that out, but just continue to use it every now and then. Okay. Let's talk a minute, if you have a below average credit score, for whatever reason, what's the best way to really tackle that and improve your score?
Well, we'd advise us first talk to a professional and get them to help you look at the credit. And then the best way is tackle one account at a time. Instead of looking at everything, what can I do? Just take one, pay it off. Pay on time, obviously, is the first thing. But then just take each one and just attack them as you can. And it could be just paying them off or paying them down.
you mentioned paying them down. This brings up another strategy that we see through different places online and different talking heads on TV, where they advise you to take the low rate offers that come in the mail. Maybe it's 0% for 12 months, transfer the balance there, and then when that 12 months is over, transfer it again to another credit card. So from a credit report standpoint, it sounds like that would impact you negatively, or does paying it off faster help you versus the impact to opening a new card?
You're correct in the first point. It is going to impact it negatively because we have a new account. But if you're going from 21% rate to 0% rate, it will help you pay it off quicker. And if that's your ultimate goal, is to get that paid off, then I wouldn't be using a lot of credit, but just constantly start paying that off.
Mm-hmm. So let's talk about, you had mentioned before too that having no credit is not a good thing. What's the best way for younger people to start building credit?
One thing is we advise is a secured credit card, which many institutions have those right now. So you put $500 down and you get a $500 limit. So you can't go crazy and buy too much. And that starts reporting to the Bureau. That's the quickest way. One thing you'll see is companies say, let me add you as an authorized user to your parents' accounts. That happens a lot. But that really is not a true indication of your credit because you're not responsible for that account. They are responsible for that account. So when it comes time for a mortgage, they typically want those removed.
So as an authorized user, it'll allow you access to the credit line, but does it actually show up on your credit report?
It will show up on your credit report, but then when you go to like a mortgage, they're going to say that's not really your account because you may be able to use it, but the bill doesn't come to you and you don't technically pay it.
Yeah, that's typically what we see as well in the banking environment.
Right.
And what we recommend too is a prepaid line of credit, like you had mentioned. It's always a great place to start.
Exactly.
So keep that in mind again, and we're going to take another short break, and we'll be right back. Please stay with us.
So who's going to do what?
I'll pack the dead batteries.
Great.
I'll only put what I don't need into a duffel bag.
Perfect. That's totally unhelpful.
No problem.
Meanwhile, I will try to comfort everyone by speaking in a calm voice. And who is going to handle supplies?
I can forget to do a list for us.
Thanks, pal.
We couldn't be any less prepared. I'm proud of you guys.
Talk to your kids about who to call, where to meet, what to pack. Visit ready.gov/kids for tips and information.
Visit aarp.org/caregiving for information on how to provide even better care for the person who wants to care of you.
You are watching Germantown Municipal Television, your source for everything Germantown.
Welcome back to In the Money. We're discussing the importance of managing your credit report today with Regina Palmertree. Regina, there's a lot of options out there to help you monitor your credit report. We discussed a little bit of that, but what are some of the things that you recommend doing?
First of all, the annualcreditreport.com is go online and you can get a free copy of your report, and that will be mailed to you from each bureau. Secondly is if you would like to put like our Equifax monitoring tool on there, and that can alert you if something happens to your account, perhaps if something's been charged, and you can acknowledge that and correct that right away.
So that Equifax monitoring tool, for example, and you have other things out there like LifeLock and just a number of different tools. It comes with the price, right?
Correct.
And then what do you actually get with those type programs?
It's a price, but what it does is it monitors it, and it tells you, just like the commercials, if you have an inquiry or you have a charge on your credit card, it will typically send you a text or a mobile, an email to alert you of that.
So does it have any protection that comes along with it in case your you're a victim of fraud?
It will. It will protect that up to certain limits based on the program that you purchase.
And let's talk about, you'd mentioned a couple times annualcreditreport.com. What is it that you get exactly from that credit report when you receive it? What does it look like?
You are going to get the report from each repository, TransUnion, Equifax, and Experian, and it's going to give you exactly what those creditors report to us, as far as their names, the balances, the payments, how you've paid, all that information from each one. So you can review that and ensure that that's your credit and that something has not been reported incorrectly, or that you're a victim of fraud, that somebody has not opened up your credit.
So it'll have every credit card, any kind of car loan or home loan, and all of those things. So just from a step-by-step for our viewers out there, let's say I get that in the mail or I get it on email and I get my Equifax credit report. What steps do I need to take as I'm looking through it? Because most people, they don't have your experience certainly. So what are the steps that they should take as they look through there? What exactly should they be looking for, and what do the line items look like that they need to, that should throw up a red flag for them?
First of all, it's going to include everything that's been reported in the past 7 years. So it could be a lengthy credit report or a short report, just depending on your credit history. I would start with all your accounts, just reviewing them making sure they're correctly they are your account. And if you find anything that's not correct, you can call those repositories, TransUnion, Equifax, Experian, and tell them that's not yours, that you need to file a fraud report.
So is it pretty common to see balances that don't match up, or payments that maybe you say, I pay this on time every month, but it's showing a late payment here? What's the process like when I do see that and I call, for example, Equifax? Are they requesting a written document from me, or is it just simple as a phone call? What does that look like?
Yes, you can call them, and you can also write them and send them information and say that's not correct. You can send them a copy of your statement, and they can call the creditor and ensure that information's correct.
So you will have to put some kind of proof, I guess. They won't just change it.
Right. Because some companies are, if you're 1 day late, you're 30 days late. So that's the trick, is knowing exactly the payment history when it's due and making sure you pay that on time.
Yeah, so that's an important point, because some places are 30 days or 15 or 10, and can they report differently, or is it all 30 days and that's it?
They can report differently, because some are just notorious for 1 day late, you're considered 30 days late. Thus, that means you're going to go on your credit report as being late. That could impact it.
That's an important tip to keep in mind then, to know that. So what are some of the things that people are surprised with when they're reviewing their credit report? Anything kind of common that comes up that people just go, well, how did that get there? Or I thought I paid that.
A lot of times it is the credit, it is the payment history saying, I thought I paid that on time, I didn't know that, or I didn't realize I had that account, I thought it was gone, I thought it was paid off, or I didn't know I had that account. For whatever reason, they forgot about it. Just a lot of surprises in that sense. If there's a lot of those with fraud, that's considered fraud. Then I would certainly contact the bureaus and have that researched.
And as you mentioned, we are in fraud season around the holidays, but it happens also year-round too. So just another reason to monitor your report.
Exactly.
Another thing that I've seen a lot is medical bills that people thought they paid off, and a lot of times it may just have $1 or $2 or 10 or 20 or 100, whatever it is, a lot less than the original bill, but or they just have never even seen the bill and it magically pops up. Have you seen a lot of that in your mortgage experience?
We have, and medical collections are a big thing, unfortunately, with the insurance. So contact the medical companies, and a lot of times the lenders pull those out a little bit and consider those based on the insurance environment that we're in, and that if you don't pay it immediately, they turn it over to collections, maybe when you go to the doctor or the hospital or something like that. So that is a surprising one. Contact them, and you can make payments on those, and we would advise go ahead and start making payments, and that way you can get that balance down.
That's one of the things where with medical bills, you go to one doctor and then they send results off to one lab or several third parties, and you may or may not even know that those bills are out there.
Right.
And then the next thing you know, when you're trying to buy a car, home, open a credit card, you have this negative mark on your credit, and and your rate is increased significantly. So beyond that 35% of getting your payments on time, what were some of the other big categories that affect your credit report and credit score?
It could be how many accounts you have, how many accounts revolving that you have, and then your balance versus your high credit, like we talked about, 35% of that. How long you've had an account. If you're out there opening everything brand new, that will affect it. And again, the types of accounts, revolving versus installment, like your car would be an installment. But if all your accounts are revolving, you appear to be a credit risk because you're just constantly opening credit and constantly charging everything up.
Mm-hmm. So is there an ideal number of revolving credit lines that you should have?
It's not really so much of a number you should have. It's based on how many you have that have balances on them. So don't have them all charged up, because again, we're looking at saying if you have a high credit of $10,000 and you owe $10,000, you're kind of a risk.
And a lot of it has to do, at least when you're applying for loans, less on the credit report itself, but how much money you're actually earning, right? And
right.
So your debt to income ratio will be very important in determining the rate that you
Exactly. Exactly, and that goes off your minimum payments, which are what were reported, and now what we're seeing too are the students with all the student loan debt. Unfortunately, it's very expensive, and that's one of the surprising things I think they come up with, is seeing exactly how much is out there being owed and how long it's deferred for and when it comes due.
Regina, thank you so much for coming out. Think of your credit score as your financial reputation. Just like your reputation among family and friends, the better it is, the better off you'll be. Managing your credit score is up to you. Having a great credit score can help you purchase a home in a better neighborhood, which can put your kids in a better school district. It can provide you with a car that doesn't always break down. It allows you to spend less on interest and save more for retirement or that vacation that you've always wanted. Manage your credit report and put more money back in your pocket, not into the pocket of the lender or finance company. That's all the time we have today. Thanks to Regina Palmertree of the Memphis Consumer Credit Association, and thank you for watching. If you'd like to see more shows, follow us on YouTube or Facebook at Germantown Municipal Television. You can also visit our website at www.gmtvonline.org. And remember, each person's financial situation is unique. Before making any decisions, speak to a financial professional to see if our discussions today are in your best interest. We'll see you next month. I'm Daniel Dent, and now you are in the money.